So we're just listening in to the Deputy Group CEO of Mubadala there, weighing in on the AI trade for 2026. I want your take on this as well, because obviously we've seen valuations running hot, particularly in public equity markets. At the same time as well, huge investment and capex going into the infrastructure layer, to data centers. Anywhere where there's AI, there's money flowing right now. How sustainable is it?
That's right. Look, I think on a macro basis, it's sustainable insofar as that our future is going to be dominated by AI, whether it's our working lives, our personal lives. So therefore, the macro, I think, works well. I do think, however, there are risks around how all these data center investments are going to be powered. So there's a issue around the energy mix of how the DC plays are going to be sustainable. And on that basis, I think that even though it's not a popular word to say these days, I think the only sustainable way to go is nuclear. In particular, technologies around small modular reactors, SMRs, which I believe is the future, and the movement towards standardizing SMRs within the DC plays are going to be an important area then.
So if energy is key to unlocking who's real and who's not in the AI trade, as someone who invests around this, what's the best way to position into that trade?
I think it really is understanding where the demand is going to come from, which countries and which regions offer not just cheap energy prices, but also the legal and the regulatory infrastructure to able to attract investment in the long term. And finally then, all of this, when everything is said and done, it's also about human capital. So what are countries doing to truly attract human capital, top-level talent, that's going to be sustainable? Because we can talk about the balance sheet, we can talk about the P&L of companies, but key management and leaders are not on the balance sheet. So it's important to attract talent to have a sustainable strategy going forward.
Certainly a key concern. Ozan, you're someone who has your eye on equities, credit, alternatives right now, basically looking at everything into 2026. What's your macro base case for the year ahead? And are you seeing anything that's giving you pause for thought or concern right now?
Look, I think the private credit markets, as important as they are, have some stuff in them that should not necessarily be there. So I think 2026 is going to be a challenging year for private credit. At the same time, it does offer opportunities, because given that no matter what the central banks do, no matter what the Fed does, ECB, Bank of England, Bank of Japan, so on and so forth, we are in an era where investors are now realizing that long-term debt as an asset class is not really feasible at these levels. So we will witness a repricing of debt in anything over the 10-year part of the curve, which will push the cost of debt, in fact, the cost of equity and cost of capital outwards. So this means that there are a lot of players in the market that will need access to private credit. It's just that investors have to be selective in choosing which companies they should go long and invest. So I think 2026 will be a challenging year in realizing that the private credit market needs to be more selective then.
Interesting, because if we do see Fed cuts as soon as this month, and maybe cuts to come in 2026, then that would be another log on the liquidity fire, so to speak. Fair to say?
That's fair. And let's not forget that investors operate on very much short-term cycles. And even though we love to talk about the long term, the reality is everything is driven by short-term incentive cycles. And therefore, we would love nothing more than a Fed cut. And I think that would spur on further equity market valuation growth. The problem with that is that we don't know when that will stop. And I get a little scared of a situation where there isn't necessarily a set event that will stop the growth of the equity markets. And therefore, I think we are entering into more uncharted territories no matter what the central banks do. It's fair to say that I think investors have to take a step back and understand where the fundamentals lie and how the fundamentals look and which areas they should really invest in, taking account of the innovation cycle that we are in globally.
There's one narrative in the market right now. I'm going out on a limb here, but the narrative is that if Kevin Hassett becomes the chair of the US Federal Reserve, then we could see potentially President Trump taking over the future trajectory of rates. What's your take on that? Is that a credible narrative? And how are you reading this leadership battle for the Federal Reserve right now?
Look, Federal Reserve governors have always been appointed by the president. So therefore, it's not something new that we are witnessing. And because markets want orthodoxy when it comes to decisions around monetary policy, I think those concerns are a little bit magnified, in all honesty. I think whoever the Fed chair is going to be will have to operate within the norms of the market. That's going to be to the benefit of the U.S. public and also world at large. So I think they will stay in a more orthodox monetary policy lane because they can't afford not to.
I ask you this because, of course, you've followed the Turkey experience really closely. Just quickly, what would you say is the translation for the emerging markets and for our region as well, particularly when it comes to the investability of some of these assets if we do see rates come down?
Sure. All in all, on a macro basis, and let's acknowledge one thing, not all emerging markets are created equal.
Yeah.
So we have to differentiate between those that have a current account surplus and those that have a current account deficit. Now, those that have a current account deficit are going to find it more and more challenging to finance that deficit, or more costly to finance that deficit. So they're not going to be in as good position as they were before. Those that have a current account surplus, aka this region, I think is a phenomenal opportunity to deploy that capital, again, in areas to attract the right human capital and invest in innovation then.